What's going on, everybody? Welcome to the Gray Report. I'm your host, Spencer Gray. And if you are at all interested in real estate investing, investing in multifamily apartments, maybe you are actually in the multifamily industry, you're an active syndicator, you're an investor, you're in the right place, because we are going to be doing a recap of basically everything that happened in the multifamily industry, real estate, and the economy, for this week. If you are subscribed to the Gray Report newsletter, you're going to be getting a lot of this content emailed to you every Thursday morning. But a lot of reports, a lot of movement. So let's just get into it. Okay, again, another exciting week in the multifamily industry, in the economy, just this everything rally is going on. We had great jobs data last week, and, we have an infrastructure bill that got passed. So let's bring in Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. And so let's just take a deep dive right into the Gray Report newsletter. Again, this gets delivered to your inbox every Thursday morning at 8:30 a.m. So if you're not subscribed, hop on over to graycapitalllc.com/newsletter, and you can sign up for this report. Again, it comes every Thursday morning. Matt, what's going on? Infrastructure bills, more spending. What is going on, I guess, over in Washington, D.C. these days?
Well, I don't have my finger on the pulse, but I think I've got a good idea that we're going to see some more spending. Legislators are working on the infrastructure bill, and then the follow-up reconciliation bill is kind of being hashed out right now. But yeah, spending in Washington, D.C., and full reports of multifamily and commercial real estate markets show that investors are spending a lot more this year as well. Given this environment, I think that the current levels of inflation will not subside anytime soon, but equally so, the current high performance of commercial real estate in general and multifamily specifically is not going to go away. So it's looking great if you're rooting for higher prices and higher rents, but there is that inflation anxiety that is just starting to ramp up, and people are really starting to talk about it this week.
Do you see it being spoken about in a more positive or negative tone? Because inflation, you can see it as, it's driving prices. It can be good for assets. But for most people who aren't invested in assets, it's really not. It's not good because it destroys their purchasing power.
Oh yeah.
So Matt, you're really seeing all the reports that are coming across the wire. Have you seen the tone change from like fear to something different? What's the tone out there regarding inflation?
I think that there's a lot of there's obviously that talk about, is this transitory? Is it not? I still think that the tone is generally anxious. No one really wants inflation. It's not helpful if it's a runaway inflation. I think that compared to the previous 2 weeks, it's a little bit more heightened, especially with the spending bill and people's kind of expectations. But it is not necessarily the kind of hysteria or the real kind of chewing your fingernails anxiety of several months ago.
Yep. I think that's a good point. Yeah, I think people are just I think we talked about yesterday, it kind of is. We know that we have elevated price levels right now, but I think most folks that are more or less in the know, if anybody is, are seeing that so many of these kind of supply bottlenecks are really more of a cause and kind of getting through this shorter term issues. So not worried about like long term, like you said, runaway inflation, hyperinflation, but definitely elevated price levels, at least for the immediate term. So we'll see. And so just related, I just wanted to look at the 10-year Treasury. Again, it's a really important metric for the cost of capital, because we had a really strong jobs report come out on Friday, and that really sent the 10-year Treasury up. It had been kind of down at 1.19, and it sent it all the way up to really we really kind of peaked there. Sorry, this is a long-term chart. We really kind of peaked recently at 1.39. Recently this year, all the way up to 1.75. But I wanted to pull in this chart because this goes back to the late 70s, and we're using we're basically kind of looking at the range that the 10-year Treasury has moved at, throughout that time. And basically, what we're doing to create this is basically identifying the high point and then the low point, the peak and the trough, and it kind of gives us a range and a channel that the 10-year Treasury could potentially move in. And I think if you look, for the past 50 years, that movement has been lower. It's been in that bottom half of that kind of like median, that mean line. And we've kind of popped out of it a couple times. Really, back here in 2018, this is when interest rates really started to rise. This is when people were getting concerned about the economy, just kind of being in its last legs. And then rates started to drop again. The Fed they had raised rates at this period in time as well. But really, you can see that, and this is where just looking at some of this kind of technical analysis is interesting. It literally hit that peak right there, kind of at that 3% level, right at the top range, and then immediately went down and hit the mean right there in the middle, and that's where it's been kind of bumping around, and we're in the top end right now. And the reason why we're talking about this and why it's important to multifamily is, again, it's the cost of capital, it's the cost of borrowing, and there is a loose but there is a correlation between cap rates and interest rates. And we don't have a crystal ball, but we can look at the past to try to get an indication of what may be going on. And the trend is typically our friend. It takes a lot to reverse a major trend. And man, this is the trend over the last 50 years. If we could have this chart go back for like all bonds, we are at a multi-millennia low in interest rate. These interest rates have continued to fall for really, hundreds, if not thousands of years. Not that there hasn't been major oscillations up and down. We know what happened in the 70s, but we are kind of staying lower, and there may be elevated levels of inflation. But man, have you looked? The U.S. government right now has over $30 trillion of debt on the books. No one wants to pay a higher rate of interest on $30 trillion in debt. They know the raising interest rates is going to kill the economy. And this whole idea of modern monetary theory is really being implanted. They're not saying it out loud, but kind of deficit spending, lower for longer. It's not going away until it's like absolutely they are forced to raise rates, which they may maybe at some point, and that will be an absolute warning sign. So again, that's just a quick update on the 10-year Treasury. But Matt, a lot of interesting reports, a lot of interesting articles in the Gray Report this week. And like you said, infrastructure bill. Senate passes a $1 trillion infrastructure bill. Now it still has to work its way through the House. Nancy Pelosi wants to pass a $3.5 trillion reconciliation package before they address that. We'll see if that happens. But the New York Times, they put out not only a really interesting article, but also some interesting kind of projections and graphs on what was in the original proposal and then what actually got passed. It's certainly pared down. I think it's still the largest infrastructure bill in the last decade, but it's really more of an actual infrastructure bill rather than a lot of other things. But some notable things did get left out, including a lot of the spending on housing. The idea that's going to go in that reconciliation bill. Matt, what was your thoughts on kind of where this, at least the infrastructure bill in its current state, passed by the Senate? Kind of what are your thoughts on how that's going to affect things?
Yeah, I noticed that too. There was talk in April really of housing's inclusion in the infrastructure bill, and that was a large part of Biden's agenda and platform as a candidate was affordable housing. And it is a little bit disappointing that there is no housing support in the bill, but that's not to say that the bill will not affect the commercial real estate markets. I think it's going to have a substantial economic effect with a bill this size. I think that the price tag of both of the bills, even the first one, even though it's 1/7 the size of the proposed reconciliation bill, even $560 billion is nothing to scoff at, and we've seen inflation that's followed from the decisions of the Federal Reserve and lending rates, and now we could see money directly injected into the economy, into all these different areas. And the Fed has been pretty consistent about addressing employment, overinflation, at least in the short term. And it's going to be interesting to see if their threshold changes as the impacts of the spending bill become more tangible and less theoretical.
Yeah, it'll be interesting. Yeah, I mean, $500 million out. I mean, we spent what $6 trillion last year on COVID related stuff, and so it's is their opinion $500 billion is it a drop in the bucket? It's still a lot of money. It's $500 billion bucks, and then that $3.5 trillion, if that actually gets spent, that I don't know where those funds are going to come from because we mentioned the COVID funds, but a lot of this, a lot of the funding mechanisms for this are taking unused dollars from past legislation, COVID dollars that weren't reused. So they're trying to do this without raising taxes, which is the idea. And so it's not necessarily 100% new spending. Some of this has already been I think priced in, but that $3.5 trillion they're talking about, that is definitely new funding, and they're going to have to raise some revenue to be able to get in order to get that done.
Yeah, it's just interesting to see this. You've got those lending rates on one hand, this making it easier to borrow money, and then this direct injection on the other hand. And it's hard not to think that there's going to be a complementary, maybe a multiplicative effect on inflation.
Well, no, absolutely. I mean, infrastructure. I mean, it's jobs. That's construction workers, and we already have a shortage, a labor shortage, right now.
Specifically, construction labor.
Exactly, and material pricing. So everyone's building houses right now, so it's definitely going to put more pressure on things. Absolutely, because of how targeted it is, and I think what you were alluding to, Matt. Even the Federal Reserve and the Treasury and Congress. They're separate entities. Federal Reserve, it's some private thing technically that can't really, they can't spend money for the government. They can print it. They can buy things. And so, really kind of like the three types of monetary policy, you've got, monetary policy 1, which is really controlling interest rates, monetary policy 2, which is like really buying assets, buying securities, buying bonds, which they've been doing at, $140 billion a month for the past year. And then monetary policy 3, which is the actual, is fiscal policy. And so it's really not monetary policy, but it's using fiscal policy to drive monetary policy and to drive spending, to increase the velocity of money and to, inject money into the system, more targeted in ways that they can't do just by, buying bonds and moving interest rates. So I definitely think that is happening. And that's what, Janet Yellen has been. She's like traveled around like central banks around the world. She used to be chairman of the Federal Reserve. She's on Treasury Secretary. She's been pushing for more fiscal spending to really kind of push things along because they can put the money into the system, but if it doesn't move anywhere, the velocity doesn't increase. It really doesn't increase inflation. But on the scary side of that, if velocity really picks up, that really becomes a potential driver of inflation. So we're gonna have to just keep watching it. And again, it's a double-edged sword. We need a little bit of inflation, but too much it erodes the purchasing power. That's why we're allocating to real and hard assets to protect ourselves and take advantage of that situation.
Yeah, so. And I think you hinted in this when we were talking about people's general attitudes earlier. Is this like we said, like people aren't tearing their hair out necessarily about inflation, but it is worth paying attention to these events that have a tangible effect on prices, both in the long and the short term. So as long as you're aware, you don't have to be, you don't have to go crazy about things, but just, know how to adjust your expectations and know what's coming down the pipeline.
Yep. I think that's a good point. Okay. CNBC, bidding wars erupt for renters as the economy recovers in a hot housing market. We are certainly seeing elevated levels of occupancy, rent growth in our portfolio in the markets that we are in and we cover. But just quick key points. They're saying these bidding wars usually reserved for home buyers, but now in rentals it's even not uncommon. Rents nationally rose 7% year over year. For 1 beds, 8.7 for 2 beds. Single family rentals also experiencing a significant surge in demand. And then it's saying basically to offset COVID eviction moratorium, some landlords are raising rents on the properties they can, knowing that demand in the market will support the increase. I don't think I think it's less of like, we've got a handful of COVID waivers, C2C waivers, So let's raise around everybody else. It's more of just that's where the market is. So that's where market
Yeah.
rents are going.
Mhm.
And that's what we're seeing. I mean, Indianapolis, I just looked at updated numbers, 12% year over year rent growth for the entire MSA. It is insane. And again, we're not seeing enough kind of new construction starts
Yeah.
in most markets.
We'll get to that. Yeah.
And and that's troubling because, we guess we really need more supply. And really, the statistic that, of all of the deliveries of this year, 1/3 of all those deliveries are only going to take place in 7 markets. So there's a handful of markets that are seeing the vast majority of construction. There's a lot of markets being left out.
Yeah.
And again, that's a case of, those markets all have really strong, solid fundamentals, but you got to just watch that oversupply. So
Yeah, I think especially these bidding wars kind of hint at the connection, the real direct connection between inflation, multifamily, and the affordability crisis in the housing market. And I think that one of the reports in the newsletter looks at how much absorption has outpaced supply, and
let's go there, Matt. Which report is that?
Yeah.
The Yardi or the CBRE?
So the CBRE has a nice top line, has some top line kind of summary numbers of absorption and new supply. It's talking about 117,900. So basically 118,000 units were built in the first half of 2021. And that's compared to the 197 units that were absorbed. So really, far along the way, almost twice as many were absorbed than were built, which is way out of balance. And I think that what's interesting is that it matches fairly closely with the pre-pandemic numbers in pre-pandemic figures in 2019, which implies that this is not a short-term problem. It's really been a long time coming.
Yeah.
We haven't been building new units for a while now, and it makes these rental bidding wars seem almost overdetermined. And I think that you can correct me, but housing demand is fairly inelastic. There's, you have to have somewhere
exactly.
to live.
Exactly.
And so people can't choose to not live somewhere. And so that really underlines the need for housing. And I think that builders are still building. They're, 117.
100%.
That's not, it's nothing to scoff at, but it's not enough. And what I'm hoping is that people recognize how valuable this is, and it attracts more labor or more investment and more development into new supply.
Mm-hmm. Yeah, I think part of it is people have been just cautious. All last year it was everyone's taking a wait and see approach. Now everyone's kind of rushing to catch up. But then some people, are still in a good situation and they don't want to overextend, which is probably healthy. But at the same time, with these prices, it's going to be an indicator to enough developers and enough investors to kind of get into get in and start building more. And again, just like, it's this job growth, this absorption, people are getting new jobs. They need to move closer to their new job. Maybe they're moving metros. There's a lot of migration happening right now. So it's just a lot of activity, and that is spurring this demand. That's why occupancy levels are so high. And then also the affordability gap. Houses are a lot more expensive than they were last year, and there was already a major affordability gap. So just, you can't even, if you want to buy a home, if you want to live in a single family home, you may not even have that opportunity. And so it's, we're seeing more construction starts. I mean, 2020, it was very low. And so we are seeing more starts, but really need to see more.
And that's one of the things that I wanted to note too, is the problem. Well, it's not a problem. The feature of the multifamily industry and really commercial real estate in general is you can't just snap your fingers and bring new supply online. These projects have it could be a year or two from beginning to end.
2 to 3 years, easy.
And
5 years.
When it comes to like the contracts for the supplies, the we right now we're seeing very low lumber prices, which is great. But those don't just automatically transfer into the price of rent or the price of a property specifically. So it's going to
not
be,
immediately.
Not only has this problem been, a long time coming, even if a solution was beginning to be hashed out right now, it will still take some time for that to work its way through the system and really, help to bring housing prices down.
Yeah, good point. And so just quick couple figures on kind of top markets, rent growth, Inland Empire out there in the Pacific, Phoenix out in the Mountain West, Tulsa, South Central, Tampa in the Southeast, Indianapolis in the Midwest, and Baltimore in Northeast Mid-Atlantic. So not incredibly surprising, but just good information out there. And again, hop on, guys got to sign up for this to get these reports, and that's all I can say.
Yeah, I paired the CBRE report with the Yardi Matrix report, and it gave similar numbers, and some, a lot of these reports will emphasize different things. And one of the things that Yardi Matrix has been tracking fairly recently is the single family rental numbers. And you noted this, and I'll give Yardi a break for coming up with the July report 2 weeks after their June report. I can keep up. That's fine. If you want to come out with a new,
I was going to mention, I was like, wait, didn't we just see this report?
Yeah. Well, but for July, it was roughly the same figures as June in terms of the year-over-year occupancy change for single-family rentals. Indianapolis is just leaps and bounds ahead of number two and of really the rest of the pack.
Yeah, in terms of occupancy change. Yeah, and I remember saw that. Yeah. I mean, the next closest is 3, and Indy is 6 in terms of occupancy change. That's
now single family rentals. It's well within the pack. It's not even
Well, the rent growth. Yeah, it's down. It's only 10%. It's only 10%, or just under 10%. Yeah. So,
but I wonder what the discrepancy here is between occupancy and rent growth relative to all these other cities, whether it's something about maybe overall housing demand is in relation to housing preferences. Maybe people prefer, but then when it comes to price, that's their ultimate preference.
I think occupancy is going to be a leading indicator for growth, because as things tighten, that's all of a sudden there's just less available. You're not going to see, they obviously affect each other. If pricing goes up, occupancy goes down. Occupancy goes up, prices will, go up as well. So yeah, I think that's going to spill over, and I think we're already seeing it into, the multifamily space, especially in a market like Indianapolis. So
that's another thing worth noting too, is we have recorded a video on, you can watch the Great Capital video on single and multifamily housing if you'd like. But a major point of that video is that housing demand pushes up apartments, rents, and home prices alike. It's again, it's a inelastic demand. People need a home, and if single families too expensive, then they will go to multifamily, and they will make those decisions, and one sector really doesn't move the entire market out of line with all the others.
Yep. I think there's definitely a relation there, and the demand is inelastic. It's just preferences, price point, renters by necessity versus renters by choice. And then, so there's two types of demands that we focus on. One is the demand for housing by tenants, by residents, folks looking for a place to live. And then there's the investment demand, people buying these assets, driving prices, what investor interest is like. And Newmark put out a report, Q2 2021. It's 2Q21. Is that how they wrote it? That's an interesting way to do it. But anyway, capital markets reports, United States. Matt, some key takeaways here.
The reports from both Newmark and CBRE both show massive increase in investment spending. Newmark has it up 175% from last year. We saw a lot of people last year. This was if you were listening or if you were reading the Gray Report newsletter last year, you probably read me a little bit frustrated with the wait and see attitude that everyone was taking last year. Well, they're not waiting any longer. And it's that
playing catch up.
Yeah, exactly. Well, it goes from wait and see to fear of missing out. And as long as you're informed, then maybe if you were a member of the Gray Report, or if you subscribe to it, you wouldn't have had that problem. But
no, the folks that were subscribed to the Gray Report, Matt, they were on top of it. They made some great decisions last year, and they've made some money if they actually took some action. So I think long story short, a lot of money being spent, a lot of money on the sidelines. I mean, there's so much money floating around there right now from individuals and institutions. Again, is what we know. The amount of dry powder accumulated by North American focused closed-end real estate funds has risen to a record $234 billion in 2Q21. Leverage at 65% LTV. This dry powder would equate to approximately $525 billion in equity fund spending power, which will continue to support higher levels of deal activity in 2Q 2021 or 2021. They switched it out in 2022. So $250 million just sitting there, needs to find a home. That's a lot. That's a lot of money.
Interesting you say home, because on page 8 of that report there, you see the breakdown of investor allocation over time. And multifamily is increasingly where this, now you do see the biggest jump in industrial, but multifamily is where a lot of this money is sitting.
Well, and that's interesting because industrial is in terms of total returns by subtype. I mean, multifamily is doing kind of like the second best after industrial, but industrial is just kicking it. I mean, look at that. Yeah. It's taken off. So that makes sense. I think people understand multifamily a little bit better.
Yeah.
It's hard to access, the industrial deals. There's less syndicators running around doing industrial deals. So I guess that makes sense. And so, I think that may lead to a good opportunity for industrial. Returns are going up. They're still not seeing the demand. Again, the demand is there on the user side. The B2B, but not necessarily on the investor side. So again, I think that could be an opportunity there. Obviously we love multifamily. That's what we're investing in. But I'm probably going to make some LP investments into industrial. Probably, I have in the past and have some, but probably up my allocation. I mean, and not recommendation, can't recommend anything, but something to at least consider for educational purposes.
Yeah, it is interesting looking at the progression of these over time, because it's not like these are halves. It goes from 2006 to 2010. These are 5-year increments. So it doesn't necessarily capture pre-pandemic versus post-pandemic or the progression of these are long-term trends of office investment going down, multifamily investment going up. And then you really do see the takeoff of industrial in the past year.
Yeah. Yep. No, you really do. It comes down to this huge boom and need for e-commerce and logistics.
Yeah.
That's what's really driving it. Obviously, that gets me excited for the multifamily opportunity that we've got going, Suncrest Apartments, that we're fully committed and funded for. But it's in the center of all this growing logistics e-commerce area in Indianapolis. So good stuff. Yeah. Okay, Matt, people, if they want to really follow this stuff, because I know you do, you're putting this newsletter together. Is there a resource that you would recommend that would help people? Like every day, like if I'm like, I need to stay on top of this, I'm in the industry, or I want to invest. Is there like a resource you would recommend?
It'd be great if there was like a website that we could go to, but.
Yeah, no, is there like a go-to? Because like we just listed a ton of sources, a lot of places, and a lot of spaces, like they don't like email it out necessarily. They like kind of like post it, but you have to like really dig around. Help me out. Is there a spot that you'd recommend?
Well, grayreport.com is the leading multifamily and commercial real estate intelligence aggregator, and anyone who wants to stay on top of the latest research reports and the latest impactful news on multifamily, commercial real estate, and the economy, just navigate right over to the Gray Report, and it will answer all the questions that you have and lead to a lot of more interesting questions that you didn't know you had. It is uploaded throughout the day, every day, and it's got podcasts, videos, really the important news articles and research that will really kind of put you ahead of the game.
Yeah, no, thanks for that, Matt. This is incredible. There's so much content on here. So if you're trying to learn more about the multifamily industry, or if you're in the industry, you're trying to stay up to date, no one has time besides Matt and myself and our team to go around and find all this stuff. So again, it's 100% free to use. I mean, sign up for the newsletter. But on the Gray Report, there's no ads outside of, you can sign up for the newsletter and join, our investment club with a couple links. But there's, so Gray Report, www.grayreport.com, AOL keyword Gray Report. So, all right, Matt, this has been a great week. And we've got a webinar coming up later today. A lot of exciting things happening. The market's been moving, a couple new projects. And so I appreciate you being on the report once again, keeping everybody up to speed, in the know, so we can make some good decisions. Thanks, Matt.
Oh, that was fun. Thanks.
Okay. All right, everybody. Again, give this video a like, subscribe to the Gray Capital YouTube channel if you have not. And if you'd like to take the next step to learn more about investment opportunities from Gray Capital, hop on over to graycapitalllc.com, join our investment club. You're going to start getting access to a bunch of exclusive content, different webinars, videos. You're going to be the first to know when we've got a new project. We send that stuff out to, first our existing investors and then everyone who joined the Gray Capital Club. And if you just have signed up for the newsletter, you're going to get information, but you're going to be probably the third or fourth kind of group that's going to get those investment opportunities. So take the next step and join the Gray Capital Investment Club. And again, you can do that at graycapitalllc.com. Okay, this has been another exciting, fun episode of the Gray Report newsletter recap. I'm your host, Spencer Gray, president of Gray Capital. See you next week, guys. Thanks.